Imagine being able to change one of the most ingrained principles of the investment world, that great profits come at great risk. Let's see how we can do that. But let's first clarify why this subject is so critical to literally everyone. Do you know how dramatically important it is to achieve even just a few additional percent points in your investment portfolio? Here it is. Suppose you have $100,000 in your account. If it grows at today's money market rate of say 1% per year, after 30 years you would have a bit less than $135,000. Not too bad, it's approximately 1/3 more than you began with. But if it grew at 7%, you would have more than $760,000. And at 10% per year, you would have $1,744,940. Even small variations in the returns you achieve in your investment portfolio, the ROI, will have a large effect on the lifestyle you can afford in your retirement years, when you rely on those funds to support yourself, your family, and loved ones. When the time comes to cash in from that account, you may end up being very happy or very sorry. What defines which way it is going to be is your knowledge of how to invest and where to invest, your knowledge of the appropriate planning tools, of the range of available options, and your asset management approach. And most importantly, realizing that you are in charge and it is in your best interest to get involved. The strong volatility experienced for the last few years in the stock market caused severe losses and forced many to retreat to more conservative investment choices, such as corporate bonds or certificates of deposit. How many years would it take to recover a 30% loss if one had to rely on 2% per year return? Quite simply, too many to afford. So wouldn't it be wonderful to enjoy much higher returns and avoid the extreme volatility of the stock market? Now this is not a dream, and we'll discuss how to do it right now. In this page, we investigate one way to implement fantastic improvements to the key component of your wealth management approach, the portion of your portfolio dedicated to more conservative, lower volatility investment vehicles. Stocks, mutual funds, and ETFs are good products. They are the most common investments, as they have been heavily promoted by major financial firms, and they are indeed a good choice for the portion of your portfolio you can dedicate to more aggressive investment products. Their major attraction is the potentially high returns one can achieve with a good selection of winning stocks or funds. But this comes at a high price. Returns and risk go the opposite way, so high returns in these investment vehicles requires coping with a high level of volatility. Volatility can be good when things go your way, but if these investments represent too large a portion of your portfolio, it can be totally devastating when things go wrong. And very recent history proves this point unquestionably. But what if this were not always true? Would you like to be able to enjoy great returns and peace of mind at the same time? Would you like to know about investments that combine high returns and much lower volatility? Private lending is the key to this. Private lending is one of the least known investment opportunities. It has been traditionally reserved to the super high net worth elite, but as we will discuss here, is now readily available to the individual investors like you and me. Continue reviewing the information in this page. You'll be pleasantly surprised at what you can do and the amazing results your portfolio can deliver.